Hey everyone, welcome back to the TraderLion channel. This is Richard and Ross, and today we're continuing on with our America's Greatest series where we're going over the greatest stocks going back to the 1900s. And today we've got a really fun one. Obviously, you guys are all familiar with this company, Netflix, and we'll be focusing on its hyper-growth period right after the 2008-2009 bear market, when it really exploded upwards after the company committed and really doubled down on streaming services. So with that, Ross, if you could scroll down just a little bit, we'll take a look at the fundamentals right before this first buy point. O'Neill highlights them here. The last four earnings per share were increasing from 0.33 cents, $0.33 to 82 cents, $1, $1.50 pretty much. Cash flow was strong. Return on equity, 23%. Pre-tax margins, 10.5%. Last three quarters of EPS, 36%, 38%, 58% growth. Sales also improving. And we've got three straight quarters of higher fund ownership. And most notably down here, as we always like to see after a correction or a bear market, this stock was making relative strength new highs before price. That's a key characteristic. And Ross, if you could scroll back up to the chart here, to put everything into context, Netflix had made a nice run from its IPO, but then it had basically gone nowhere and consolidated for 5 straight years. So if you had tried to trade it in then, you wouldn't really have made any progress, as not until it was coming off these bear market lows that really started shaping up and forming those leadership characteristics and qualities that we like to look for. From this first buy point, the cup and handle right here, this was a super powerful stock, a little bit choppy at first, as Ross will talk about here and here. But from this point on, we get a nice run, and you can manage risk against the 50-day moving average and just trail that stop all the way pretty much until the ultimate top of the stock, and basically get out with most of your profits intact. So with that, Ross, I'll hand it over to you. We'll go base by base and discuss how you could buy, how you can manage your position, and ultimately sell.
All right, absolutely, Richard. Thank you. So here we're looking at Netflix on its weekly chart. Here's first real clean cup and handle on its weekly. You can see we've got the pickup in weekly volume on it as it's moving back towards highs. It gets nice and tight on the pullbacks, accompanied by declining to below average volume. I mean, then here we've got, this is, I'm not going to say, we know, as Ray loves to talk about, this isn't, I don't know that this is the biggest volume in a year, but volume up 543%. On a given day. That's very significant. That's letting you know that, as Bill used to love to say, that's not Grandma Tilly buying that stock. You've got some big funds with, a lot of money to spend going in there. And that, you've always got to keep in mind that funds, the big guys with tens of billions of dollars will take weeks and months to ultimately accumulate a position. And remember, it's not just one of those funds out there. There's a bunch of them. So without rambling on, that's why institutional sponsorship is definitely important, and that's your cue that the big boys are stepping in to buy the stock here.
Right.
So keeping that in mind, again, and as frustrating as this might be, a round trip that ultimately tests its 50-day, and ultimately that becomes its buy. Let's say you watch it wiggle below that 50-day and pick it up on a reclaim, and then again from that point you can trail its 50-day all the way till here. You get a chance to buy it back again, as the leaders often will do, but let's not get too far ahead. So we can see we got a nice solid run out of this stock before it builds its second base on top of this one. Unfortunately, the low of this base stays, it never really even touches, this high up here. Not to mention you've got that super tight action in there as it's holding its average. That's going to give you a little bit of confidence, right? So you're ultimately holding above that high. You've got constructive action in here that is typically indicative of accumulation. We try and move up and out around here. The stock ultimately doesn't make it out, but holds its 50-day and begins to tighten up again, right? So at this point, you're looking at one of those, you're getting that volume contraction pattern. Things are, starting to close in. And as sometimes happens, and ultimately in this case turns out to be a constructive shakeout after the fact. And this, this is not an easy hold here. A big weekly break below its 50-day moving average like that, I'll tell you right now, for me, that's going to get, depending on where I bought the stock back here, where I may have averaged up, that's going to get me to sell at least a portion of my stock. On the other hand, you've got to, again, it depends where you bought it. At the end of the day, pulls back right to that super tight constructive area. That's where it ultimately finds support. But again, there's nothing wrong with buying a stock back higher. You don't have to buy it back. It doesn't matter if it costs you $4 or what. It doesn't, because as long as you are managing your risk and you're more or less you're at a tiny loss or at a tiny gain, it doesn't matter what you've done as long as you're able to stay disciplined to the point that a stock actually works, right? And so again, by here, this would have had me drooling, no doubt. And you get another bout of frustration here. And ultimately what happens, when we're not looking at the market, you're coming into earnings here, right? So you break below its 50-day. And for us at TraderLion, even though you've got the solid weekly close here that comes well off lows, that would tell you in and of itself that that's a sign of strength and accumulation. Just the fact that it closes under its 50-day for a second week in a row, we're probably going to step away and look to buy the stock back. And sure enough, this is an earnings gap right here. If you're patient and you've managed to keep your emotion, because remember, not only are you managing your financial capital, but your emotional, psychological capital along the way. So, I was just discussing with Richard before we started shooting, it's not even having the strength to be able to buy Netflix here because you've been so worn out. It's all about getting to a point where you're following your rules and your discipline emotionlessly as possible. If you're not going to do it emotion free, we're human beings. Sometimes it's going to be better than others, but you at least want to have maintained that stay as neutral, as even keeled as possible and manage risk. So when you finally do get here on that earnings catalyst, and there's ways to cheat your way in. For those of you who are familiar with, how I mark up charts on the top 10, I'll draw some semblance of a declining tops line if there is one, connected as much as possible. Well, in this case, you're looking at your 10-week line here and a potential consolidation pivot, assuming. So at this point, yes, even if you did get pushed out on this round trip back here and have to buy it back even $10 or $12 higher, does it really matter as long as, again, you're position sizing right? You haven't, gotten too crazy in your head, and sure enough, you finally get a break here, right? It's like that power of three that you'll hear people talk about. The first two times, frustrates the what out of everyone, and finally on that third time, when most people give up, they're like, I'm not touching that thing again. That's when it finally goes. So there's a little psychological thing there to that. And then finally, the earnings right here, and look at the volume here. Volume up 266% as it comes off its 10-week line, and my guess is we'll look at the daily. That looks like it's holding its 10-day moving average. Just that look of it, and like as is typical of most leaders, with solid sponsorship, you're going to get support at that key 50-day moving average for most of its run. Again, here you may get pushed out, but it's not that hard to get back in along the way. Even if you do get shaken around, it's a liquid stock. It trades fairly well. So if you have a discipline, your edge, and you're managing risk along the way, you can still do very well in the stock, considering that you may get pushed out a couple times along the way or struggle in the end. But otherwise, it gives you from this point on, other than this shaking here, and again, depending on where you bought it prior, it depends on how you handle it, whether you hold some, sell it all, buy some, it doesn't really matter. But at the end of the day, even if you had waited till here to start buying the stock, you're getting more than a double, right? About $130, touches almost a little bit through 300 before it ultimately reverses there. So you don't even need to touch any of the stock you can almost triple your money from here, which is, it's pretty incredible, right? That's the point of being in these big leaders, even if you get pushed out, and what I like to say is that sponsorship is super important. This is what Bill would say. It's what sticks in my brain. It's these big, high quality names with the solid performing institutions. That's why these stocks will typically come in and be supported at logical areas of support. The thinner, choppier names, you're going to have you'll have a much harder time holding on to. And I'll tell you what, the market has been noticeably more volatile in the last several years, I would say, just from an observational standpoint, than it has been prior. So. Yeah. That being said, what have you got to add, please, Richard?
Sure. So I'll just add a few things. First of all, you touched on this before, Ross, but this base right here to me looks like a larger volatility contraction pattern. We've got this first move down, moves up, then moves down a little bit less, moves back up. and then we've got one last contraction before it shoots off. So if you're a shorter term swing trader, you could have probably gotten a nice move out here before it starts correcting before earnings, and the volume pattern and also declining left to right, and then we get a nice move up on the breakout. So I think, yeah, that's definitely something to mention. Additionally, like we said, you might have gotten pushed out before earnings. You could have bought it back through a few levels if that was possible. But you've also got the setup that George Kachuk, the U.S. investing champion of 2020, the money manager division last year, taught me, where he likes to look at a high volume close and buy it back through that close. That becomes a very important level for him. So that could have been one way to get back into this winner. And
Love
let me,
that.
yep, absolutely. And just looking at how it acted after earnings, this is completely normal. It stays very tight. It holds 80, or actually it holds 60, which I'm sure Ray would have been watching this stock back then if he had been trading this. He loves those round numbers, but it holds 80 on a closing basis. Very tight action on that week right after earnings, and then just moves up and doesn't look back until the double bottom base. So yeah, depending on your time frame, you might have handled this completely differently. If you're a longer term guy and you bought it right here, you could have sat until it breaks really a longer term moving average, even longer than the 10 week, the 40 week. But definitely you want to have both an entry strategy and exit strategy, because after this point, after this top, as we'll take a look at in MarketSmith, this declines basically 75, 80% over the course of the next year. So just because you think you've got a big winner, you believe in the stock long term. We always say we buy on both fundamentals and technicals, but we sell only on technicals. And there are clear signs that the trend was changing on that chart, as we'll get into in MarketSmith. So with that, Ross, let's go on over to MarketSmith and take a look at this chart. All right, so here we are now in MarketSmith taking a look at the monthly chart of Netflix, just to give you the perspective that I was talking about at the very beginning of this video. So here is when Netflix IPO'd in 2002. It had its first decline and then a super powerful run from 5 to almost 40 in under a year, it looks like, right during its IPO advance phase. However, it had some big technical weakness, definitely signs, especially if you go to a weekly or daily chart, to get out of the stock at this point. And it basically consolidated and went nowhere for 5 years until really the time period we're talking about in this video, this nice run off the bear market lows. However, after this bear market in 2008, 2009, Netflix acted like a true leader. It's starting to move towards all-time highs before the market was coming off its lows. We had that relative strength making nice new highs before price. And yeah, the rest really is history. And now let's go on over to a daily chart and take a look at these bases and how you could have traded it in depth. All right, so now here we are on a daily chart, taking a closer look at the cup and handle and that VCP base. And looking at the daily chart, you actually kind of see how messy this entire base is. And this is the cup and handle breakout right here. And it actually ultimately fails, and most likely you're stopped out at the open here on a big earnings gap down, it looks like. But the reason that everything is so messy is because liquidity is probably very low at this point, simply because the overall market is not healthy. So this is why the market is such an essential part of Can Slim. If the market is right, if the market is wrong, these liquid leaders with great earnings, stories, all of that are simply not going to work right. It's not until the overall market turns around that we really see some performance from stocks like Netflix. So with that said, let's zoom on over to the
And
end
I would
of,
just say this,
yeah, go ahead.
pointing in, Richard, this notice this breakout happened during that. The S&P 500's on a new lows,
Downtrend.
new lows, new lows. So, the fact that this breakout, yeah, yes, it was definitely earnings, but at this point, you're definitely wondering when's the mark, is it going to buck the trend forever? But anyway,
It's a
it's just
basketball
giving you,
underwater. Yeah.
showing you how strong it is. And then ultimately, I think our relative strength line gives us, the big Q way ahead of time, as you had mentioned. So, and you can
Yeah.
kind of see why there.
Yeah, definitely it's trying to buck the trend and acting like a basketball underwater. So at this point, it should be making your new highs, relative strength new highs list every day. And you're just waiting for that market to get that fall through day and start another uptrend. So with that, let's move on over to the next base. And now we're moving forward and taking a look at the second base, the kind of longer term volatility contraction pattern. You can see that even at the beginning, it's very sloppy, but as you go from left to right within this base, it does tighten up and start to show a much better character change here. And let me erase this and draw in this base high, the green line here, as Dr. Wish says, at 50.24. And this is really where I would be starting to get interested in a stock like Netflix, a nice long-term base within the context of an overall 5-year base. So a pretty long base for sure. And then we get some nice constructive moves. It starts respecting the 10-day, 21-day exponential moving average, the pink line here. And we get a super strong breakout right here. So that's most likely where I would be watching it, moving through this pivot on above average volume. And what's also interesting is as we looked at the previous section, it was trying to fight the market, making relative strength new highs. But even after the market turns, it actually kind of just base builds until this point a few months later. And that's when it starts a super strong trend that we saw over on the weekly chart. So with that, Ross, anything to add about how Netflix is acting?
I just want to point out Netflix on its final huge breakout that works ultimately after it breaks out, ultimately pulls back, retests that pivot, and it doesn't do it quickly. It definitely lets you suffer for close to a week before it finally, takes off through that, ultimate high. That's all I would point out is that is not uncommon for a stock to break out and frustrate you a little bit, do a little retest of the pivot before it actually takes off and goes. So
yeah, and all of that is on pretty low volume, so pretty normal action. So with that, Ross, let's move on forward and take a look at the rest of the uptrend. All right, so here we are moving forward. This was the breakout we were just talking about. And from there, it does move up and trend above its 10-day, but ultimately pulls back below that moving average as well as the short-term pink line, and then really frustrates you below the 50-day moving average here. And most likely, I would not be holding it through earnings, especially if you bought it at this breakout. It's a complete retest. And most likely, I would be stopped out as it gets under the pink line as well as the 50-day and starts living below that 50-day moving average. However, after this earnings gap up, this is super strong action, nice closing range on this day as well. It acts really nicely after that, the big earnings breakout. It stays there for a few weeks and gets you in right at a consolidation pivot, right at that level. And from there, this is when it really respects that 10-day moving average all the way up until it forms this double bottom base. Which definitely is a little bit nasty here. But once again, even if you are shaken out, you could have gone out and back in through the shakeout +3 or another setup. Or even if you wait until the breakout around 130, you're riding the rest of the move pretty much up until its top. So Ross, anything to add about this period during the trend?
nope, not at all. Oh, that covers it.
And here we are now at the top of Netflix's run during that period. And you can see how it got a little bit wider and looser, especially towards the end. And then it breaks those key moving averages on volume. You really start to see the volume come into the downside right during this period. But from that point, you're below a declining 50-day moving average. The trend is against you. The overall market as well looks to be in a shorter term decline. And this market leader, this former market leader, really gets hit hard and declines 80% over the next year or so. So once again, this reinforces the idea that you don't want to fall in love with the stock. You want to honor your rules. And when it starts breaking those moving averages on volume, and especially when it's later in the move, you really want to respect that and get out, move on, and wait for it to set back up, which it never does until later on in its life cycle. So Ross, anything to add about this pretty much destruction of Netflix at this point?
No. As you hear people say, nothing good happens under the 200-day, Richard.
Right. And we see a declining 50-day, 200-day. And when that happens, I mean, the majority of the destruction is right under that declining 200-day moving average. So with that,
the death cross, right, that everyone likes to point out, which literally has very little statistical significance, although I point it out because people constantly talk about it and ask what the golden cross and death cross is. So there it is, but it's relatively insignificant.
Yeah, that's kind of a late indication of what's really happening. The break of the 50-day, I think, is the more significant
Right.
break right
there. The back gap down break below, and you try and get above one day, just stall, you're right back below, and it's pretty much done from there.
For sure. And with that, thanks so much for watching. If you enjoyed, go ahead and leave a like down below and subscribe if you're new to the channel. And we'll see you guys in future videos. Thanks.